In this video, you will be seeing about capital structure management. Capital structure management refers to the process of determining the optimal mix of debt and equity financing for a company to fund its operations and growth. The goal of capital structure management is to balance the risks and benefits of different sources of financing to maximize shareholder value. There are two primary sources of financing for companies: debt and equity. Debt financing involves borrowing money from lenders, such as banks or bondholders, that must be repaid with interest over a specified period. Equity financing involves raising capital by selling ownership shares in the company to investors, who become shareholders and receive a share of the company's profits in the form of dividends or capital gains. The optimal capital structure for a company depends on a variety of factors, including its industry, size, growth prospects, cash flow, and risk tolerance. A company with stable cash flows and low risk may prefer to finance its operations with a higher proportion of debt, as it can take advantage of tax benefits and lower interest rates. On the other hand, a company with high growth potential and a more volatile cash flow may prefer to finance its operations with equity, as it can avoid the burden of debt payments and maintain flexibility in its financing. The primary considerations in capital structure management include cost of capital. The cost of capital refers to the cost of raising funds through debt and equity financing. The cost of debt is the interest rate paid on loans, while the cost of equity is the expected return demanded by investors. The goal of capital structure management is to minimize the overall cost of capital by optimizing the mix of debt and equity financing. Financial flexibility. Companies need to maintain financial flexibility to respond to changing market conditions and unexpected events. A company that relies heavily on debt financing may face liquidity problems if it cannot make debt payments, while a company that relies heavily on equity financing may dilute shareholder value if it continually issues new shares. Risk management. Companies need to manage their financial risk by balancing the risks and benefits of different sources of financing. Debt financing can provide a tax shield and leverage the company's assets, but it also increases financial risk if the company cannot meet its debt obligations. Equity financing avoids the risk of default, but it dilutes shareholder value and can limit the company's financial flexibility. Market conditions. Capital structure management also depends on market conditions, such as interest rates, investor demand for shares, and the availability of credit. Companies may adjust their capital structure to take advantage of favorable market conditions or to reduce their exposure to unfavorable conditions. Overall, capital structure management is a complex process that requires a thorough understanding of a company's financial needs, market conditions, and risk tolerance. A well-managed capital structure can help a company achieve its financial goals, maintain financial flexibility, and maximize shareholder value. Thanks for watching. Like, share, and subscribe.